Howdy, everybody, and welcome to Liberty Call. Today is Thursday, May 1st, 2025. Hope you're having a fantastical day. You can see my main man, Nolan, here. He has been grumpy today, and so he's sitting in my lap during the show. So he also ate the arm off one of a stuffed reindeer. So if he gets sick, we'll know why. So, all right, well, market tripped higher today as Microsoft and Meta delivered knockout earnings, lifting the NASDAQ to a one-month high. This rally comes just a day after the news of a shrinking U.S. economy, and with tariffs looming, investors are pinning hopes on big tech to keep the wheels from falling off. So before we get into all the news, I need some help from you. If you could do me a favor, give me some thumbs up, a like, share, subscribe, to follow, and press the notification bell. All right, well, let's get into the markets. Starting out with the Dow Jones, it was up 0.21%, 83 points, closed at 4752. S&P 500 up 0.62%, 34 points, closed at 5603. NASDAQ up 1.52%, 264 points, closed at 17,710. The VIX was down 1.38% today. It's at 2436. Canada down 0.19, Brazil down 0.02, and actually Brazil was closed today, and so it appears so is Mexico. We'll skip those. Headed over to Europe. Germany was up Germany was closed also. Moving on to the UK, they were up 0.02. France up. France is closed. Let's see, Netherlands. Most of these are closed. Actually, all of Europe is closed except for the UK. They were up 0.02. And let's see. Let's go find if anything else was open. The Russians were closed, and a couple things here in the overnight markets. The Nikkei in Japan was open. It was up 1.13%. Australia up 0.24%, and New Zealand up 2.5%. Everything else closed today, probably for May Day. That'd be my guess. All right. So that was everything there. My little fidgety man here who is just being so good. All right. Well, let's move on to the market recap for today. Let's see here. What do we got? All right. The S&P 500 surged Thursday, driven by strong earnings from tech giants Microsoft and Meta platforms, which reignited investor optimism in artificial intelligence and powered broad market gains. Meta platforms jumped over 4% after posting better than expected Q1 results and raising its 2025 capital expenditure forecast to $64 to $72 billion, up from prior guidance. Analysts at Wedbush highlighted Meta's AI integration across its ad and content platforms as a major growth catalyst. Microsoft soared more than 8% after reporting a 13% rise in quarterly revenue and projecting cloud growth of 34 to 35% for Q4. RBC noted the company hasn't seen a material macroeconomic or tariff-related demand impacts through late April. Investors awaited earnings from Apple and Amazon after the bell. Meanwhile, McDonald's fell over 1% after reporting a surprise drop in global comparative sales, citing difficult market conditions. Other notable movers are Eli Lilly, down 11% after disappointing sales of its weight loss drug Zepbound. Biogen, slightly higher as rare disease drug sales offset declining MS revenue. And Estee Lauder dropped 10% due to weakness in travel retail and sluggish Asian consumer sentiment. Initial jobless claims rose by 18,000 to 208,000 last week, possibly reflecting early layoffs from tariff-related disruptions. This comes ahead of Friday's key non-farm payrolls report. And the U.S. economy contracted 0.3% in Q1 for the first time in 3 years, largely due to a surge in imports as firms rushed to beat tariff deadlines tied to Trump's tariff policies. All right, so that's everything there. Good stuff. Move on over to, let's see here. We got a research report from First Trust, the April ISM Manufacturing Index. This was put together by Nate Gersey. So let's see what he had to say. U.S. manufacturing activity declined again in April, though not as severely as expected, highlighting ongoing weakness in the sector, now compounded by tariff-related uncertainty. The ISM Manufacturing Index slipped to 48.7 from 49, marking yet another month below the 50 threshold that separates expansion from contraction. While some subcomponents like supplier deliveries improved, the production index fell sharply to 44, and order books remained historically weak. Tariff confusion and supply disruptions are weighing on business confidence, with many customers delaying purchases until tariff impacts become clearer. This hesitation is feeding back into the labor market as manufacturers slow hiring. The employment index continues to contract, with more industries cutting staff than adding. Supplier delivery times lengthened, with deliveries index rising to 55.2, the highest since mid 2021. Although not at COVID era extremes, supply chain bottlenecks are clearly worsening due to tariff negotiations and complex customs calculations. A major red flag in the report was a jump in input costs. The prices paid index rose to 69.8, the highest level since the inflation spike of 2022. This suggests inflation is reaccelerating even as factory output remains tepid, a troubling combination. Elsewhere, initial jobless claims rose by 18,000 to 241,000, and continuing claims surged to their highest level since late 2021, indicating mounting labor market pressure. Meanwhile, March construction spending fell 0.5%, driven by a decline in residential building. All signs point to an economy under increasing strain from tariffs, inflation, and weak demand. Yep, not good at all. So, all righty. Let's get to our next article here. The potential winners and losers in reshoring supply chains. This was written by Charles Hugh Smith of the of2mindsblog.com. Mr. Smith argues that the success of reshoring supply chains to North America hinges not only on but on a broader cultural shift in values, priorities, and economic incentives. In the short term, consumers may face shortages, rising prices, and corporate profiteering disguised as tariff fallout. However, in the long run, domestically controlled supply chains could bring stability, durability, and quality back into focus. Qualities undervalued until crisis reveal their worth. Let's see here. He highlights vertical integration as Ford's historic River Rouge plant as a potential model for resilient manufacturing. While less cost efficient on paper, such setups offer security against global disruptions and geopolitical risks. Winners in the reshoring era could include vertically integrated companies, unions if public sentiment shifts, and local producers if consumers begin to value stability and local jobs over low prices and poor quality. Smith emphasizes that real change depends on public demand. If society continues to prioritize cheap goods, the broken global system will persist. But if national security, quality, and fair wages become priorities, reshoring and rebalancing economic power away from finance and back to labor may succeed. Until then, the comforts of the past remain, quote, on back order with no estimated delivery date, end quote. All right. Good stuff. All right. Got one last article here, also from Zero Hedge. It's titled Schiff, the bounce is just a bear market rally. So all y'all who have gotten giddy because the markets have kind of bounced back here, Mr. Schiff has another opinion. So you can always watch the video. It's linked in the show notes if you want to see it. So let's see. Let's go through this quick synopsis. Peter Schiff returned to his podcast to unpack Wall Street's recent volatility, describing last week's stock surge as a typical, quote, bear market rally, end quote, designed to lull investors into false optimism. He argues that the market's bounce was fueled not by real economic improvement, but by political manipulation and misleading commentary from the Trump administration, especially regarding tariffs and trade negotiations. Schiff criticizes President Trump's ongoing pressure on the Federal Reserve Chair Jerome Powell, accusing Trump of demanding rate cuts for political reasons and likening his attacks on Powell to schoolyard name-calling. He also accuses former Fed Chair Janet Yellen of politically motivated inaction under Obama, pointing out she kept rates at zero until Trump's presidency. The podcast highlights Schiff's longstanding view that the Federal Reserve is more influenced by political agendas than sound economic principles. He warns that the hopes of tariff rollbacks are empty and that upbeat trade war messaging is strategically released to manipulate market sentiment. Finally, Schiff offers a contrarian view on China, arguing it would ultimately benefit from breaking financial ties with the U.S. He claims that the U.S. pays for Chinese goods with worthless IOUs, hurting Chinese long-term economic health by sustaining an unsustainable trade imbalance. All right. So that is that. I agree with a lot of what Mr. Schiff says, that trying to get the Fed to lower rates is more for political reasons and to help out big Wall Street and big business. So Anyways, as you can see, my main man here is falling asleep in my arms. So we're gonna go play and go hang out with the other dog, Jake, who's probably he's not real happy that this little guy is here because he's demanding a lot of attention right now. So, all right. Well, hope everyone out there has a. Oh, hang on before we go too far. If anyone needs to get in touch with me, where do we go? DSAFinancialGroup.com. Doodle-doo-doo-doo. All right. Well, that's everything that I had to cover for today. I hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.